How do you improve your retirement outcomes? We've already identified these 3 steps. Now let's take a closer look into managing returns. How your savings are invested will determine how your money grows. The division of your savings among different investment types, such as stocks, bonds, and cash equivalents, is called asset allocation. Why is it important? Studies have shown that up to 91% of your investment return is a result of your asset allocation, rather than the specific investment options you choose. Determining your asset allocation strategy is the first step to improving your retirement outcomes. Your individual asset allocation will depend on the investments available to you, your risk tolerance, and how much time you have to invest. Now let's look at the 3 basic steps to develop your asset allocation. First, you must understand 3 fundamental asset classes: stocks, bonds, and cash equivalents. Stocks, also known as equities, are shares of ownership in a company. Historically, stocks have greater investment risk than the other asset classes, but have the highest potential return. Bonds, also called fixed income investments, are loans made to governments or corporations. Cash equivalents are usually short-term investments designed to maintain their dollar value. Examples include money market funds and treasury bills. Cash equivalents offer lower returns in exchange for lower investment risk, yet they may not always keep pace with inflation over time. Each asset class can go up or down at different times and for different reasons. Investing in more than one asset class, or a combination of the 3, may help balance your risk and improve your retirement outcomes. How do you feel about investment risk, the chance that your investments could lose money? The balance between risk and potential reward that you are comfortable maintaining is your risk tolerance. Why is it important? All investments involve some degree of risk. An aggressive investor, or one with a high risk tolerance, is willing to risk short-term losses to get potentially better returns long-term. A conservative investor, or one with a low risk tolerance, is willing to accept lower returns in exchange for low investment risk. How do you find your risk tolerance? Your RPA advisor will take you through a questionnaire to determine your individual risk tolerance. How much time do you have before you retire? 10 or 20 years? Even longer? Often, people think their time horizon is between now and when they are done working, which is when you start to use your retirement savings. Actually, your time horizon is between now and when you stop working, plus the time you spend in retirement. That could be 20 or 30 years depending on your age and health. We know that getting started is often the hardest part. Now that you have reviewed a few basics, contact your RPA financial advisor to determine your asset allocation strategy.